Joining me now is Jason Horn from Steyn Capital Management to give us his take on markets activity. Jason, thanks so much for your time this afternoon. Big question here is, has markets calmed down? Are they calm? Are we seeing some calm return to markets, particularly in the US over the past few days? The Nasdaq and the S&P 500 hitting record highs. We also saw in Asia the Japanese Nikkei trading near a 4-month high today. Should we rest? Should we chill?
Thanks for having me. I think it is a bit of a head scratcher. I think if we look at the US market, it's almost worryingly so, where it's back at where it was prior to all the issues we've had in the Middle East. I think broadly speaking, nothing has changed from a US market perspective. I think if we look at Q1 earnings in the US, was very good. I think the reality is US valuations are again looking stretched after this relief rally we have seen over the last few weeks. The question remains: are we is earnings going to be as good in Q2 when earnings season starts in the US? And then obviously traders are looking towards what's going on with the Fed, and currently it looks like markets are pricing in about 63 basis points of rate cuts. And it seems that has ignited some of these animal spirits in the US market in particular.
And sticking with the Fed, the independence of the central bank back under the spotlight as Powell's term comes to an end next year. There are even reports suggesting that Trump is considering replacing Powell as early as September or October. Are you concerned about that?
I think longer term, probably not. Look, we don't know what's going to happen at this point in time. I think all we can look at is what the Fed is saying. Obviously, the president would love the Fed to be more dovish, but the reality is, at this current moment in time, the Fed does have a very specific mandate on inflation and employment. And even though, yes, the softer data may be weakening, and at the margin, the labor market may be weakening, but the hard data, particularly around inflation, is still not in the target range. So it's very difficult for the Fed to cut rates at the moment. We do have the Fed's favored measure of inflation coming out tomorrow, core CPE. We'll see there. The Fed very much remains data dependent. And going forward, yes, we're going to continue to see, until we start seeing that rate cutting begin again or continue, we're going to continue to see pressure from a rhetoric perspective on Fed Chair Powell.
All right, let's shift focus to the earnings scene. H&M out with numbers, posting a rise in sales and profits, further saying they're noting a pickup in summer shopping. The sustainability of that, questionable, of course, considering the looming tariff deadline, as well as, you know, concerns around inflation, considering that the US is H&M's second biggest market. What have you made of those numbers out today? I saw the share price really charging ahead.
Yeah, look, market really enjoying the results. I mean, it must be said that there were pretty downbeat expectations considering all the tariff disruptions we've had over the last few months. They're expecting sales in June to rise about 3%. Just having a look, operating profit was a beat. Impressive margin performance, gross margins up to about 55.4%. And the CEO indicating that that's going to be a real focus point for them going forward for the rest of the year. Like many global retailers, the company is under pressure to offset these high input costs, including the US tariffs on Chinese imports.
A few updates on the local front, starting with Growthpoint, the firm raising its full-year guidance for a second time and pointing to improved property fundamentals here at home. Now, while rental growth rates improved, the lease renewal success rate declined. That, I guess, just showing that tenants are still looking out for deals when it comes to renewing their leases, right?
Absolutely, and I think if you look at the results, marginally positive, and most of this is driven largely by management's strategy to focus more on the SA portfolio rather than offshore. We have seen the slight improvement in vacancies to approximately 8.4%, and then, I mean, if we kind of dig down into the South African fundamentals, we're continuing to see this this improvement. Obviously, as I mentioned, vacancies and yes, renewal rental reversion rates are improving across all sectors, and obviously just from the EBIT generated from the V&A waterfront also grew an impressive 23% for the period.
And we're seeing this a similar trend playing out in Hyprop's update, where they are seeing an improvement in vacancies across all of its property portfolios. Talk to me about that result. They also have exposure in Eastern Europe, another buffer when South Africa doesn't perform as well.
Absolutely. I mean, operational metrics are looking good with the South African trading densities up 10% and Eastern Europe up 3%. Guidance also unfortunately revising that down to between -1 and +2 from +4 to +7%. But I think you're right there. Overall, positive update.
All right, let's hit pause on the conversation, Jason. Before we move on to your stock pick, let's take a moment to touch on some counters that your industry peers find interesting.
Capital Appreciation really is a payments business and a software development business. The payments business has been growing very quickly. It's focused on terminals, and they have a few other products in between. But they've really been innovating in terms of the terminal product that they offer. They rent and they sell terminals to merchants, and I think digitization and payment continues, and the technology required will continue to intensify. And they've got the software development side in the background that also actually helps this terminal business. The software development side does a lot of other stuff as well. Unfortunately, it has been overstaffed over the last couple of years. Yeah. They're trying to right-size that now to bring that part of the business back towards more sustainable margins long term. But they've got really great IP in that space as well. So I think from a longer term perspective, the stock I think is a really solid investment. It's trading on a forward P of below 7 times, forward dividend yield of about 9%, even after the Pop post the trading statement 2 days ago. So yeah, putting my money behind Capital Appreciation.
Top 10 companies in the US at the moment, 3 are semiconductors.
Yeah.
You've got NVIDIA, Broadcom, and TSM. Even though TSM is technically Taiwan, it's still in the top 10. And I think we're experiencing unparalleled growth now. I just think we're going to get another massive wave of spending in AI-related companies, and just generally tech, and they're incredibly well placed. They're very smart. They're actually the powerhouse in the industry because they've got capabilities and leadership there that I think are unparalleled. So it's one that we haven't put too much attention on, but I think I'm very happy to add them at this stage. Very, very crucial company if you're in AI.
So both analysts betting on tech with TSMC in the chip sector, as well as Capital Appreciation, a local one, a small cap, but really making moves when it comes to the payments and software side. What are your analysis on those counters?
Absolutely. Capital Appreciation is a name we actually used to hold, and quite successfully so, not one we hold currently. Yeah, just reported really good results. I mean, that's driven by a strong performance from their payments division. Look, offset by margin pressure on the software division due to overcapacity. The business does remain highly exposed to sales of payment terminals, which, to be honest, can be very lumpy. But it does seem that they are making progress on increasing annuity and recurring revenue streams within their operations. And then TSMC, again, spoke about this a few weeks ago. Fantastic high-quality business with a lot of structural tailwinds going forward. You can think of them as kind of like a toll road on AI and advanced computing. I mean, they're really dominant with over 90% market share in advanced chip nodes and 68% market share in all semiconductor production. Very, very, very good company.
So you like both of those counters, but they aren't your stock pick. Where are you seeing opportunity today, Jason?
Well, my stock pick is a bit different today. I'm going to be pitching a short today.
Okay.
Pop Mart International. We are short them. They are giving my age away here. The new cabbage patch maker, or think of Beanie Babies.
Okay.
The Chinese toy maker, where the share price has actually gone up 14x over the last 2 years. So it's been driven by popularity of a collectible soft toy called Labubu.
Yes.
Yes,
They've been
and
doing
this
the
is,
rounds on
it's
TikTok.
gone viral. Yes,
Yeah.
exactly. Look, I mean, we have seen this before and we believe it's a fad. I mean, it's now trading at 50 times forward earnings. So the market expects this business to continue growing at this rate for the foreseeable future. Look, we don't do valuation shorts, but occasionally we do short fads as well. So we do believe Pop Mart is a fad, and when you have people selling their products on eBay for triple the market price because the company is creating a false scarcity, we think that is a fad. So I mean, just recently, Pop Mart has reported they've conducted large-scale restocking of its popular Labubu toy series, which is leading to a sharp drop of nearly 40% in resale prices on the Chinese second-hand market. So definitely a potential short here.
All right, let's leave it there. Thanks so much for your time and sharing those insights. That was Jason Horn from Steyn Capital Management.